Stocks rallied to the close on the back of the morning's producer price index, which came in lower than expected. Tomorrow, we're going to get CPI for July. But do these reports have less bearing than they used to on the Fed's decisions? Well, joining us now is Krishna Guha, Evercore ISI Vice Chairman. It's great to have you back on. I want to start right there. What's going to matter more this week? CPI tomorrow or claims on Thursday, since we know the labor market is softening?
I think it's all about the labor data at this point. Within very broad tram lines for inflation, it's going to be the labor data that decides how many cuts we get from the Fed this year and whether the Fed will have to move past our baseline of 325 basis point cuts, that's a quarter point in every meeting, to deliver one or more of those big 50 basis point cuts. It was an inflation first Fed. It's now a labor data first Fed.
So in light of that, I realize that unemployment is still pretty low, but it's been moving up and moving up quickly. So how much does the velocity of that move factor into that decision making?
You're absolutely right that as with most pieces of macro data, you're looking at both the level and the delta, the speed of the change. Now, unemployment has been moving steadily up. That has now gotten to 4.3% in that last print for July that triggered so much market turmoil. I think the Fed takes the view that, 4.3 plus minus, not a terrible number, but they don't want that number to keep moving up. So their challenge is to try to arrest the softening in the labor market. And it feels like they are going to have to get their skates on in terms of rate cuts to make sure that that happens, that they're able to stabilize the labor market rather than risk this softening turning into something more severe, more worrying, more potentially likely to be associated with the onset of some kind of recession dynamic.
Meantime, we're in election year. We're sitting, as a country, we're sitting on a giant mountain of debt. We have geopolitical tensions that are simmering in the background as well. You're already seeing shipping rates, for example, perk up. We've seen some movement in oil, although albeit some selling today, perhaps with no new headlines propelling the concern. But how real is the risk that these types of activities or these types of dynamics could actually push inflation higher again?
Well, you're absolutely correct that this is a very complicated moment with a lot of geopolitical tensions. And absolutely, if, God forbid, the conflict in the Mideast were to escalate out of control in terms of Iran, Israel, direct conflict, potentially drawing the U.S. in, then we'd be looking at an energy price spike, maybe more disruption to shipping as well. I do think, though, that fundamentally the U.S. economy, it takes a lot to knock it over. I'm focused more on the domestic dynamics here. And this question as to whether what we're looking at is just a somewhat bumpy soft landing, that's my baseline case, or whether there's something more dangerous underway. I don't think that's right, but I'm going to be very focused on looking for signs. And the Fed should be too. It's about managing risks at this point. And the risk management has shifted from being upside inflation risk to downside employment risk.